Congratulations on a world economic outlook that really goes into the nuance of the global economy. And within that, you call it a delicate moment. Discuss that. Why is it so delicate in 2019?
We are projecting a weakening of the global expansion from 3.3% in 2018 to 3.3% in 2019. So that's 3.6 to 3.3. And then we're expecting a recovery in 2020 back to 3.6%. However, we see this as a delicate recovery because it's going to rely on a recovery in Argentina and Turkey and many stressed economies of the world. It's going to rely on the euro area not slowing even faster than we expect, similarly for China. So this is a precarious situation. And there continue to be many downside risks. I mean, even though the trade tensions look like they've improved, there are risks to trade.
The risks are plural, as you mentioned, many of them right now. What's the certitude of recovery? I mean, you've got to line up the ducks, including U.S.-China trade and many others, Brexit, et cetera. Within that wide set of risks, that doesn't give you a lot of certitude of recovery, does it?
On the other hand, we've certainly had more accommodative monetary policy by the U.S. Federal Reserve,
yes.
You know, the European Central Bank. We've also seen large amounts of monetary and fiscal stimulus from China. So those policy interventions could help growth. And as long as things stay stable, we expect some of the stressed economies to recover towards the end of this year.
Some of the stress, John Farrell, my colleague, pointing out the huge swing in German economic outlook, just as one example. Part of this is moving from multilateral to bilateral to what I call Trump lateral trade. What does your world economic outlook and your financial stability report, your fiscal monitor, what do they say about the unique trade policy of the President of the United States?
The trade tensions that came up in 2018 between the U.S. and China is an important factor that weighed negatively on growth towards the end of 2018. Now, we are certainly seeing some improvement there, but we continue to be concerned that trade tensions might spill over to other sectors and other countries. For instance, if it were to hit the auto sector, that would bring in many more countries and affect a bigger chunk of the global supply chain. So that's something we flag as a very important risk. And you know, that our forecast assumes that would not happen. Now, if that were to happen, that would again be a negative knock on growth.
Gita, I pulled a chart out from 20 years ago as my chart of the year last year, the twin deficit, the dynamics of trade deficit and fiscal deficit in the United States. Can you report to Madame Lagarde and to the President of the United States that we can see a stabilization of the U.S. trade deficit? Or within the combination of your world economic outlook, do you just assume a wider U.S. trade deficit?
The nature of what's going to happen with trade deficits in the U.S. depends on the different levels of aggregate demand in the U.S. relative to other countries in the world. And given the fiscal expansion, given the fiscal stimulus that was put in place in the U.S., that would keep deficits in the U.S. higher right now compared to other countries. And similarly in China, the fiscal stimulus that's been put there is going to reduce their surplus relative to the world. So we think that these macro factors are very important going forward in determining the size of deficits. And typically when you put bilateral tariffs in there, it leads to trade diversion to other countries in the world, as opposed to reducing the overall size of the deficit.
Gita, your report speaks of good news of stability in China, stability in India, and even growth. You have unique perspective, particularly on Indian economics. Coming out of the election, can India actually advance emerging market GDP? Can India really get a head of steam going and pick up 100 or even 150 basis points of economic growth?
I mean, India is, the largest, the fastest growing large economies in the world, growing at over 7%. And our projection is for growth to be about over 7% both for 2019 and 2020. Now, we've seen a revival of investment in India. We're seeing consumption being strong. And the fact that oil prices came down towards the end of 2018 is helping India. Now, going forward, of course, we'll have the elections soon. But what we've experienced with India is that economic policies tend to be rather insensitive to who is in power. So they tend to be, the reforms tend to go on, and which is why we are optimistic about the future outlook.
Gita, I want you to defend the PhDs at the IMF. I know this is something sensitive, and certainly the IMF always a piñata of forecasting economics. I heard this at Ambrosetti in Italy with our Francine Lacroix in the recent days. Gita, can the IMF extrapolate out economic growth in performance, or is it more of a static analysis?
Well, you know, forecasting is fraught with uncertainty. I mean, we make our best projections given the information we have at this point. And for many countries, we have information from their budgets about where fiscal policy is headed. We have information from monetary authorities about the projected path of interest rates. And so that enters our forecast. So that's real information that goes into our forecast, and that is dynamic in nature. But of course, over a year, many things can happen, including natural disasters, including certain rules. And so that will obviously impact the numbers.